Welcome. You're listening to the Best of Investing on Talk 910. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And for those of you listening for the first time, here's our format. A few guys sitting around a bar having drinks without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hoff of Pacific Private Money, California's fastest growing private lender, and Robert Spinoza of RPM Mortgage. We have too much fun. This ought to be illegal, I gotta tell you. Our phone number is 888-912.
We're not even cheating yet.
We're not even cheating yet. Yeah, 888-912-1190. Write that number down. And today's trivia theme is Disneyland. Disneyland, but it's not. This is not going to be quite as easy. There's going to be a couple of hard questions. Okay, our website is bestofinvesting.com. Check us out on Facebook and YouTube, and go ahead and click the like button if you will by typing "Best of Investing Radio Show." We're also on television, Comcast channel 26 and AT&T UVerse channel 99 on Saturdays at noon and Sundays at 6 p.m. Mark, you've got some interesting construction information for us.
Well, yeah, most real estate investors know that the two necessary ingredients for a strong housing and economy are jobs, number one,
yep,
and building permits.
Yep.
And so the good news this past week is that both are up. So, for example, in the California employment market, we've got employment year to date is up, well, 0.6%. Not quite as much as they had hoped. They were looking for maybe 100 to 125,000 new jobs. We're a little bit below that.
But that's statewide.
Yeah, statewide.
Okay.
Statewide, not nationwide,
right,
but statewide. In fact, the number that they have on their statistic is we're up 83,000 jobs year to date through May, not June, but through May. And then contrast that with the fact that construction permits, also through May, are up 51% year over year.
So even in today's hard political climate, it's still easy to get construction, or easier to get construction permits?
I think the other thing we've got to look at is, you go back just a few years, and both of these numbers were drastically and painfully down.
Well,
so,
in fact, that's why most people were saying we were in a false recovery because jobs were not showing growth. Well, because you need job growth to create housing demand, and with housing demand, then you get hopefully new home starts, which will then fill the available inventory demand.
Well, regarding the permits, I remember Nevada had changed and made it easier, mostly in commercial, to get permits because they were realizing, that they were not making enough money and they needed to issue more permits. So they realized, if we lower the cost, then we'll be able to get more construction.
And you think about, I heard a statistic back in when we were in the doldrums. I heard a statistic for Burger King. And what struck me about that is that one of the things, Burger King derives a lot of its revenue from laborers who work on housing and construction. So this goes downriver a long ways. You talk about starting with permits, a number like that, but there's so much that flows from that.
I thought they made money from hamburgers.
Well, you're right on about that because there's a trickle down effect of construction. Is one of the largest contributors to the economy and to economic growth that there is. And so it's really important that new housing starts increase, and the sooner the better. Now, from my company, Pacific Private Money, we make loans to real estate investors. We're also seeing a lot more applications for construction loans. Now, we're getting those because some of the banks are still they're still kind of coming back slowly into the market of construction lending. And a lot of contractors out there, quite frankly, they've got dings in their credit because of what happened when the market turned. Even though it's now 5 to 7 years later, still that a lot of them had foreclosures and lost properties, and they're still not bank financeable yet. So they're coming to private lenders for construction funds. And so the point is that not a day goes by that I don't get a request for a new home build somewhere in the Bay Area.
Yeah, what do you think from the bank standpoint of the construction lending? How much are they paying attention to, the FICO scores, whether or not the guy went bankrupt? You know what I mean?
Oh, I think on the conventional side, and again, I'm with RPM Mortgage. We do conventional lending, a jumbo but conforming, and all the things that most people, 9 of 10, are going to get when they buy a home. And construction lending is still not at the forefront of what we're doing. It's not come back. I still think most of your big banks and most of your conventional mortgage lenders are not looking at construction as a component of their year. 2013 certainly, and not even 2014. And if they were to view it, they would be viewing it very, very FICO dependent, very income dependent, and the scrutiny would be very high. That's my take on it.
Well, and then that's an important point.
Which leads to, yeah.
Frank Dodd created a lot of new regulations in the banking industry, and so if contractors and home builders are able to get permits, that's only half the battle.
Right.
The next half is, where do I find the financing to build that? So it's going to be important that the banks do get back into the market of construction lending, because quite frankly, as much as I would love to make construction loans privately, I also know that it's expensive, and I can't offer the rates that a lot of contractors will need in this market so that they can make the appropriate profit.
And it's very important when getting a construction loan, don't have any equipment on the property. Because
right. Don't start early.
Don't start early. A lot of people, it's so funny. It's amazing how many times, and you probably get this too.
Oh, I do all the time.
Construction loan, and a typical bank won't lend if they see the construction equipment. They say, yeah, but we started early to make it simple and let them know we're going ahead. You go, have you ever heard of mechanics liens?
Yeah. But if you're a borrower out there and you're looking to buy, fix, and flip existing property or new build, you absolutely do not want to start before you've closed on that acquisition loan to get that financing. Because the title companies will do a drive-by, and if they see that any work is started or they see a construction truck out in front, they won't close.
Good point.
Yeah.
Very interesting. I don't have much to add on the construction side. We don't, we over the last few years haven't seen it in conventional lending. But one thing I did want to mention, Mark, is that you brought up, contractors and this time horizon of 5 to 7 years, but I deal with contractors all the time. I stay in touch with them, and they're not 5 to 7 years removed from it, because building their pipelines has been a much more arduous process.
Right.
And so, they're in a lot of ways like real estate agents. This recent uptick, this momentum that's built over the course of 2013 is a welcome, improvement to their conditions over the last few years, and I've heard that from many, many contractors.
So if you are a contractor, you're looking at getting a building permit, and your bank is still telling you no, do try us at Pacific Private Money, because even if we can't lend directly, I have got a network of people in the industry right now providing construction financing.
Okay. Tell you what, we're going to go to our first commercial break, and again, the theme is Disneyland. All right. What is the name of the ride that takes you on a boat through a whale? The first 3 callers with the correct answer. It's not Space Mountain. The first 3 callers with the correct answer are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912.
Use my lifeline.
Yeah, exactly. Phone a friend. 888-912-1190 to answer this question. What is the name of the ride that takes you on a boat through a whale? 888-912-1190. Make sure to include your name, your email address, speak slowly, spell out your email 1 letter at a time. Don't touch that dial, because the best of investing will be right back. Good.
It's a small world after all.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hanfa of Pacific Private Money and Robert Spinoza of RPM Mortgage. When we cut to the first commercial break, we ask this trivia question. Again, the theme is Disneyland. What is the name of the ride that takes you on a boat through a whale? And no looking on the internet.
It's not It's a Small World?
It's not It's a Small World.
I don't have
There are no whales in It's a Small World. How about Storybook Land? See, that's one of those esoteric rides.
That's my favorite ride.
Yeah, you forgot. Okay, let's get right into email time here. Mark, we have an email from a listener that says, I've been listening to the show for a few weeks. Only a few weeks. God, that rascal. You should have been listening
we love
for
new
3
listeners.
years. Okay. And I heard that you now have a fund. Is there any advantage to waiting until the fund is larger before I invest, or is there any advantage to investing in it earlier? That's actually a pretty good question.
Yeah, getting it.
Yeah, that is, and that's always a concern, I think, for people who are talking to companies that are promoting their what I will call a mortgage pool fund. A mortgage pool fund is a fund where individual investors can invest in a private placement, and their funds are used to make loans. Now, in our case, we make loans to real estate investors, generally no more than 70% of the purchase price. We're doing first trust deeds, we're doing first position loans, first mortgages to real estate investors. That's our niche lending. Those loans are generally short-term and paid back usually within a year. And they pay pretty high interest rates. The notes on those are anywhere from 9 to 11%, and the shareholders in the fund, after expenses, expenses are earning somewhere in the 8% range is what we're generally projecting. But the question is would I want to get into the fund, early, i.e. a charter member, so to speak, or should I wait till the fund, has grown in size, maybe has a track record, et cetera?
Right.
Well, one of the reasons we started the fund is we have a 5-year track record at Pacific Private Money. We've made over 500 loans, 100 million in originations. We're currently servicing 25 million of that 100 million that has not yet paid off. That we've originated most of those loans in the last year and a half, 2 years. So we do have a track record, but again, getting back to the question, interestingly enough, the early investors in our fund are actually going to be earning a little bit higher than the target rate for the fund. The reason for that is, in our particular case, is that the fund manager is picking up most of the expenses and startup expenses of the fund. So we're not running expenses through the fund. We're just running the note yield and some of the origination points. So the people that are in right now, I think over the next couple of quarters, are going to see actually a boosted return on an annualized basis. And again, we're targeting long term somewhere in the low to mid, somewhere in the 8% range, between the low and high.
So that fund
range
smooths out the individual investor's risk and term on the loan, in other words. So somebody could get into the fund and then they could hold that long term and they would continue, all of the actual investments within that fund would somewhat be transparent to them. They just continue to earn their yield.
One of the benefits of investing in a mortgage pool fund is that your investment risk is spread among all of the loans in the fund, as opposed to those who like to invest in whole notes or individual trust deeds, where they're actually making they're funding one loan to one investor on one property. The reason that funds are growing in popularity once again is because there are an awful lot of sophisticated private lenders, sophisticated individuals who have a ton of money, and they're snapping up most of the individual loans that are made available. And since my company now is kind of steering towards the fund model, the good news for a passive investor, or even a formerly active investor in individual trust deeds, might want to strongly consider the fund model, because rather than going in and out of a note that pays off every 6 months and then have to stand in line and wait for the next opportunity and then fight over it with somebody else and then probably lose out multiple times, as some of my trustee investors have discovered lately, rather than go through all that pain, just write a check to the fund and go about your business, because you can earn 24/7 on that.
Well, I've got an extra little plug here for Mark. He and I went to a seminar on Wednesday and ran into, actually the guy who was putting on the seminar was a very, very sophisticated real estate attorney. He's an investor and he's an attorney. And it turns out that he wrote a check to Mark's fund for $100,000. Now, this is a guy who could look through the documents and pick them apart like crazy, but he's dealt with Mark before. He looked at the fund. Yeah, it's a that's an absolute great testimonial. And I've looked through the documents myself, and I'm looking at it and going, I really appreciate the certain intricacies in the fund that Mark has put in to benefit the investors.
Now, the fund is only open to accredited investors. That's most funds have that restriction. But if you want more information, certainly give us a call. Be happy to provide you that.
Or
mortgage pool funds. Or go to the Best of Investing
website.com. Okay, Robert, we got an email for you from a listener. It says, I have noticed that the 10-year Treasury rate has increased a lot over the past 6 months. Have mortgage rates followed to the same degree?
Good question. And if you're watching anything out there, what I found is the public is watching the 10-year. So over the last 12 months, I don't know. I mean, let's talk about what a lot is, right? So we were at 1.6 and now we're at 2.5, something like that. So, but still, that's a big jump over the last couple of months, especially. Rates have gone up as a result of that. If you were in the 30-year conforming fixed rate market in May, you were looking at April, I should say, you were looking at 3.5%. If you're in that market today, you're 1% higher than that. And just about every index has confirmed that, the Freddie Mac survey, all that kind of stuff. So what do you do about it? How do you treat that? And what impact will that have on the real estate market? We're trying to figure that out right now as we go forward. Is this an irreversible trend? Is it going to continue higher? Or will we see things trend back down to where they have been over the last year? Tough to know, but understand that a lot of what prompted the increase is tied to two different things. One is some relatively positive employment data. Again, you have to put that in perspective too, and does it even keep pace with population growth? Some would argue it doesn't, but nevertheless the employment numbers are better than they were. And that in turn causes investors to think that the Federal Reserve might end its extremely accommodative monetary policy sooner than some thought. And that's what's causing the spike in bond yields. So I tend to see this as a market reaction more than a fundamental move. And we'll see how the housing market interprets that over the near term, meaning through the summer and into the fall.
Hey Rob, I got a question for you. So you go from 3.5 to 4.5. That's nearly a 30% increase. I didn't notice any screaming headlines, and maybe that's a good thing from the media going, "Oh no, mortgage rates are up 30%."
well, they're catching on now, and I think the public is getting
very misleading, by the way, that headline, if it were in fact out there.
Yeah, and you have
they don't have it.
You have to keep in mind that even at 4.5%, you're still you're still 4% below the historical average on a 30-year fixed loan, which is in the mid-80s.
Most people, it's still, what have you done for me?
What have you done for me lately?
Yeah,
Absolutely.
So how you're currently have? I assume you have some loans that you're working on.
Yeah, sure.
Are your borrowers kind of saying, they're probably coming to you and saying, "Rob, tell me what to do. Should we?
Yeah, exactly.
Should we close now? I mean, Or
yeah. So this is a great question, and it's a conversation I have all the time. So if you're dealing with a refinance, that's extremely rate driven. But on the other side of that coin, you control the time frame, and you're acting if you can. If you're at 4.5% and rates go to 3.5, you decide you want to refinance. Great. If during the time you're in the process, rates go to 4.5, there's no incentive to refinance at all. But it's your transaction; you control that. Much trickier when you're buying a home, because now your close of escrow is likely set by the contract and it's 30 to 45 days away. You've got to make a call on what's going to happen with this. There are two components to consider. One is, do you still qualify at the higher rate? Okay, that's my job, and that's the kind of thing where those who are in escrow need to know that first. If the answer is yes, then you have to make a call on rates. And right now I favor locking in what's available. If things get better, you take advantage of it when that happens. There's a saying amongst pilots, it's better to be on the ground wishing you were in the air than in the air wishing you were on the ground. Okay, that's the way you've got to treat interest rates in this environment. We have very high volatility the last few weeks. We've got spikes higher. You don't want to get on the wrong side of those. Get something locked in, if you qualify, and then if things do improve in the near term, you reconsider, you take action when you can.
So there's this house for sale, and there's 20 offers. I'm in the fourth backup position.
Right.
And I'm offering 25% under market, and I have a contingency that says rates have to drop below 3%. Do you think I'm going to get that house?
You might have difficulty on this one.
Not like that. Okay. I'm just kidding, audience.
But stay positive.
I may be dumb, but I'm not stupid. Okay. We're going to cut to our second commercial break, and again, the theme is Disneyland. What is the only ride that hangs from the ceiling? Don't touch that dial, because when the best of investing comes back, we've got some interesting articles about health insurance and something called bitcoins.
Wow.
Stay tuned. Okay, here we go. Welcome back to the best of investing. I'm Edward Brown, your host, along with Mark Hahn of Pacific Private Money, California's fastest growing private lender, and one of the smartest mortgage guys I know, Robert Spinoza of RPM Mortgage. Our trivia theme is Disneyland, and the second trivia question, because it's summertime, right?
That's right.
All right.
We're not on vacation.
No, we're here in the studio, pumping out this awesome show. Okay, what is the only Disneyland ride that hangs from the ceiling?
Is it Haunted Mansion?
No, because that you're in your chair.
Remember that? I don't remember if it hung from the ceiling.
How do you guys know this stuff? I haven't been there in, I don't know.
Haven't been there in years?
All right, what is it?
Peter Pan's Flight. One of my favorites.
All right. No, that's a good one.
That's a good one. Okay, getting into a couple articles here. Bitcoins. what is a Bitcoin? It's a virtual currency that can be used to buy and sell a broad range of items, from electronics to illegal narcotics. Yeah, baby. And it was created.
Really?
It was created 4 years ago, and
Built an audience.
Yeah, and the thing is, they trade Bitcoins. I mean, it can be traded. The funny thing is, it's almost like you would think there'd be this like illegal underground type of, okay, forget United States, we're going to have our own currency type of thing.
So Bitcoin, isn't that the company that is co-owned or owned in part by the Winklevoss twins, the Winklevi?
I believe, yeah, let's see, one Winklevi, two Winklevosses. Yes, that is correct. They are part of this company. They own 1% of all Bitcoins outstanding. So it's like, reminds me of Bunky Hunt.
So go over the premise again. So
okay,
how does this differ from regular currency? And
well, that's what kind of amazes me. Okay, the value of Bitcoin.
Generally, the concepts that are difficult to grasp are the same that don't
usually work out.
I don't know that I'll be buying stock in.
Forgive my ignorance there, but
okay. So first of all, they have a value that has varied widely, reaching a high of 266 in the second quarter and a low of 45. Of course, when you trade money, it's always money, isn't it?
Right.
Okay.
So
Bitcoins are created or mined by computers that solve difficult cryptographic problems to verify transactions. I have no idea what that means.
Yeah.
And
is it like barter?
That's what
it's like a barter exchange where you
like
get credits for some service or product.
But there are barter exchanges that already exist.
Yeah, absolutely.
And they just don't actually issue coins, and they don't go up and down in value. It's just whatever I don't get it.
I agree with Rob that if it's difficult to understand, it's probably not going to be the next Facebook.
Well, get this: pioneers could mine coins on their laptops. I mean, there's going to be some fraud going on there. So now
is that like mining for gold in the local creek or something?
Something like that. Now high-powered computer equipment is needed.
Well, okay, so the allure the allure of the product seems to be that what's happening is you are creating the value of you are creating the value yourself. So this is a technology that is allowing you to create the value that you can then apply to something else. I think that's where it's going.
Well, I guess. Okay, so what happens when you get one of those 3D printers? So they've signed up over 4,500 merchants across the world to accept payments. The currency was trading at $90 this past week. This is actually as of July 4th. Let's see, regulation is unclear. They might be regulated, but they might not. But here's the interesting thing: is they don't think that they are securities. So you can trade these things, but they're not securities. And so this one guy basically says Bitcoin is in many ways the cyber version of gold.
Okay.
Wow.
Okay.
I'll take this and
we should probably talk about something we actually understand on the show.
But wow, I mean, one of the other things about that is I don't. If you're involved in the creation or the funding of that, what is your exposure to regulation? My God, I mean, how do you predict?
It's all underground. You just trade it like you traded cocaine boxes or marijuana bags or three
it's
fingers.
A family show
fingers.
here.
Yeah.
Well, no.
Wow.
I'm not suggesting that. I'm just saying that that's what's out there. Okay, let me change subject here. Health insurers fear young people will opt out. So we have Obamacare.
Blowing up the Obamacare model.
But yeah, basically.
Yeah.
So what happens is, I understand it here, just to educate the audience here, the way insurance works, talk about health insurance, is you hope that you have a whole bunch of young, healthy people in the system paying who hardly ever use it, and that helps pay for the older people.
Kind of like Social Security. People paying into the program won't use it until later on, years later.
That's right, basically. Okay. So what ends up happening is, they give this example. Here's a 24-year-old who is fairly healthy, and he makes only $48,000 a year. And if he stays in the system, it's going to cost him $3,000 a year for health insurance. Okay. He can opt out, and it's like, okay, we got to pay a penalty. Guess how much the penalty is? $100.
So it's less than half of what his premium is.
No, $100 total.
Why would they pay $3,000 for a premium?
$3,000 compared to $100.
$3,000 divided by 12 is
So we're not talking $100 a year. It's $100.
Period.
Period.
I got it. Okay.
Yeah. So it's like, what is that? less than 3%.
Yeah.
So somehow the math on that seems pretty obvious. I think I would go for $100 and
go for the $100,
and not pay $3,000 on something I might not need.
But then you got to figure out where you can at least get some kind of insurance.
Right.
Who knows? Maybe there'll be an underground bunch of doctors getting
together. But that's not even our argument here, because our argument is Obamacare is working under the premise that what will happen or will stop happening is the exploding costs that are related to people going to the emergency room. If you take a young person out of this pool and you put them out without insurance, what happens when they get, when they fall off their skateboard and, break their ankle? Where do they go?
Well, they'll probably go to the emergency room, and we're probably still going to have to take care of them like we do all the people who don't have insurance.
That's
anyway.
my point. So it's a double whammy if you're looking at this article that way.
That's a very good point. So they're saying if enough young adults avoid the new insurance marketplace, it could throw off the entire equilibrium of the Affordable Care Act.
Yeah.
Well, of course it does.
So obviously what they'll have to do is the insurers are worrying that the $100 penalty might not be enough of a deterrent. Gee, do you think? And it says here the penalties jump to $695 or 2.5% of taxable income, whichever is more, by 2016. I mean, can you imagine? And they say that this is not a tax or whatever. What is it? A penalty? You must have insurance.
Yeah, but the thing about it is it's there's no simple solution. Obviously, if there were, it would be in place.
Everyone should stop smoking, lose 100 pounds.
Yeah, well, I'm with you on those.
Yeah.
But still, the fact of the matter is that you can't escape our healthcare system right now. The cost can sink this country, and that's been brought to light in recent, the Bitter Pill article in Time that was very, very extensive and exhaustively covered.
Yes.
I mean, you're looking at, and so I applaud the Affordable Healthcare Initiative, if only because it moves things down the road to hopefully a solution that can work for the country. Because
in other words, just changing from what
because
we got something that's broken.
The path we're on is unsustainable. So
no, that's true. Just like Social Security,
right?
It's like
right.
we'll eventually go bankrupt. So
somebody's got to deal with it, and and this is a manifestation of it. The perfect being the enemy of the good, and hopefully we can get around it.
Well, it said here, okay, the cost of health coverage is difficult to estimate because it includes so many factors. But a 27-year-old making $30,000 a year in 2014, kind of typical, will have a $3,400 premium and will be eligible for subsidies that cover about 26% of that bill. The person would end up paying $2,500 a year. That does not include deductibles, though.
Okay, so that's still a lot of money for insurance.
That's absolutely. I mean,
it's a lot of money.
When I was a kid, when I was a very young adult, and I think I had Kaiser, and I think I remember paying about $50 a month.
Right.
I pay less than that for a family of 4, and I'm in my 50s for Kaiser on a monthly basis. I pay less than that for full coverage.
How much you pay total?
About $1,400 a month for a family of 4.
Wow. See, now, okay,
with the two principals over 50, my wife and I.
I've got, here, now, audience, take this into consideration.
And he smokes while he skydives. Now,
okay, so I've got Blue Cross.
Okay.
And I'm not necessarily a proponent of them, but I've got Blue Cross. My premium actually got lowered a little bit.
What?
I guess because of this affordable.
That must be a mistake or a glitch.
I'm not
never goes down.
It never goes down. Yeah. It kept going up. But now I pay $500 a month for a family of 4, and I'm in my 120s. No, I'm in my 50s, right?
And you have a $500,000 deductible.
Close. I got a $7,500 deductible. But again,
it
goes back to, we're relatively healthy.
Yeah.
Hardly ever go to the doctor. So a high deductible makes sense. I'll save so much money. That $7,500 I'll be able to bank so that if I do need the deductible, it's there because it's a maximum of $11,000 per family.
And with Blue Cross, you can go to your own doctor, which is kind of nice.
Yeah, exactly.
Okay, well that's actually really good. Now, of course, I feel like I'm overpaying. I'm going to talk to you after the show.
Let me throw one thing into that argument though. So let's take our worst case scenario. What did we say the 27-year-old would pay $3,400 a month before the?
Not a month, a year.
A year, rather. I'm sorry.
A month.
They're making less than that.
Right. So then he would have that reduced to about $2,700 or whatever.
Yeah.
Okay.
$2,500.
What is that same 27-year-old paying for car insurance during the year?
Well, it depends on what if they have bad record.
Okay,
most people are not going to pay $2,500.
No, I know, but let's throw out some numbers here.
$800 a year.
$1,000 a year, I was going to say, something like that. Okay. But I'm just trying to draw some relativity to the whole thing.
Well, but it's hard, because what happens if he's driving a Maserati compared to a 1962 Volkswagen?
Yeah, but a 27-year-old making $30K a year is not driving a Maserati either. So, but where's he living?
Well, that's true. That's an excellent point.
I'm just
Mr. Spinoza. Stop confusing me with the facts.
Yeah, I resemble that remark.
Exactly. Okay, and with that, we're going to go to our third commercial break here. All right, the theme is Disneyland. This one's a little easier. The Blue Bayou restaurant is a neat restaurant overlooking which ride in the dark? Don't touch that dial, because we're going to have some awesome stuff here when we return at The Best of Investing. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn from Pacific Private Money and Robert Spinoza of RPM Mortgage. When we cut to the third and final commercial break, first of all, we have to make a correction here, because Robert was correct. I made a mistake on something here. I had accidentally said that the restaurant, Lighthouse Resort, I said, yeah, the food's not very good. I wasn't talking about that. I was talking about the Blue Bayou restaurant. The food at the Lighthouse Resort actually is excellent. Mark and I were there over 4th of July.
Yeah, when you visit, order the crab po' boy. That was like
that was
really
very,
good.
Very good. Okay. So the Blue Bayou restaurant in Disneyland is a fairly neat, cool restaurant overlooking which ride in the dark?
Don't know.
Pirates of the Caribbean.
Oh, that would have been a good one to just throw out there.
Is it Caribbean or Caribbean?
I say Pirates of the Caribbean.
Potato.
Okay. And before we move on to one other thing, I got to give a nice little plug here to Kramer Herzog, our videographer. He was in the front page of Section B of the IJ.
Good job,
because
Kramer.
he did something called the Eye of the Storm, which was filming the Tukey Williams execution that happened some years back, and he did it from the perspective of filming the Fox News and all that, because he allowed them to stay in his house. So
right.
It was really kind of neat to see how, when the camera was on people, how they acted a little differently,
Right.
and some people were very objective, and other people were really sincere. Other
That's
people
pretty
were
insightful.
Yeah,
Good work,
so it was
Kramer.
really cool.
Yeah.
Check out Kramer Herzog's Eye of the Storm on his website. And let's see, Mark, you had some kind of interesting updated information for us.
Well, there was this Jobs Act passed by President Obama in 2012 in April. Jobs Act standing for Jumpstart Our Business.
Wait a second, something got done?
Yeah. Well, when the
jobs,
some of the components of the Jobs Act included two things that are of particular interest to me, being in the financing business, and one is the whole issue of crowdfunding, which a lot of people have talked about. It's been in the news. It's a big deal. Well, crowdfunding is not yet legal to do. And we've all been waiting for the SEC to issue their general guidelines, and they're very, very close to that. They made progress on July 10th, paving the way by issuing some regulations relating to crowdfunding. And the second part of it is most mortgage pool funds are set up under an esoteric ruling of the SEC known as Reg D, or Regulation D. And so and those funds generally are not allowed to advertise publicly, and so they've actually lifted the ban on general advertisements.
Can you give the definition of crowdfunding? Because I'm not sure people.
And so going back to the crowdfunding, is what the Jobs Act had intended to do was to create a mechanism where, via crowdfunding over the internet, you could raise up to $1 million for a business endeavor. And so, but the crowdfunding proponents, and there's a number of companies that have been set up and are kind of poised and ready to assist individuals who want to use the crowdfunding model to raise money for their business idea. They've been waiting for the SEC to actually issue the guidelines. So major progress was made. It looks like earlier this year we were thinking it might not happen until the end of 13 or the beginning of 14, but now there's been some real progress made. So that's the good news. And just getting back to the those syndications under the Regulation D for funds and for fundraising above the $1 million, that the ability to advertise is a big deal, because before you could only really expose those opportunities to people with whom you had a prior business relationship, and that just makes it really difficult to raise substantial sums of money. So the whole idea is to jumpstart the business opportunities within the economy by assisting people who are looking to raise private capital, make it easier to raise private capital. The flip side of that is that we're all going to have to be even more aware of the fact that people will be out there trying to take advantage of this. And
the social dynamics of it are quite interesting.
Yeah, the social dynamics are very interesting, and so they're going to be those, the criminal element out there is going to be out there as well. So you're definitely going to always want to be on your guard and do your due diligence with any company that advertises investment opportunities and high returns. Transparency is definitely going to be the rule of the day when it comes to these investment opportunities, in my opinion.
With freedom comes responsibility, right? So it's
was that from Spider-Man?
I think so. Did you make that? Thomas Jefferson, I think, close. I don't know. But what I was going to say is actually the crowdfunding thing is. You look at it like that, and you could hear a chorus of people screaming, "Oh, there'll be scammers out there." But on the other side of that argument is when you're unable to access the public, then people make the argument that it's the old boys club. That only these people that
only people with money
right, they're the only ones exactly, and so
the man's holding me down.
Yep. So you get arguments both ways, which is why I think it's very, very interesting socially.
Which, by the way, I think it's with great power comes.
Yeah,
that was from Spider-Man.
I didn't go to college. Come on, give me a break.
Have you ever gone to the movies? Peter Parker, Tobey Maguire.
Well, we'll find that out on the next show when we do movies as trivia, right?
That's right. Do these names ring a bell? Yeah, in fact, we're going to do trivia of Indiana Jones movies coming up here pretty soon.
Oh, really?
Yeah,
that'll be
next,
good.
All right.
I'll do good with that. Harrison Ford.
You think so?
Yeah.
Yeah, that's snakes. Yeah, those are all the answers. Okay, that's all we need.
Show's canceled.
Gee, what are we going to talk about?
Nothing to talk about now.
Summer vacation.
Summer vacation. Okay.
Which, by the way, I'm going to Maui in a couple of weeks.
Good for you.
I'm thinking of you guys while I'm on the beach at the Grand Wailea, our favorite escape.
Oh, you rascal! Bring me back some sand or something.
You can't do that. It's bad. Yeah, gods don't look favorably upon that.
Oh, that's right.
Madam
Yeah,
Place.
there is something about that. You're not supposed to. I did used to vacation with somebody who liked to take a little canister of sand from every beach they visited, and I thought that was kind of cool. But you're right. Bad luck. Bad juju.
Yeah.
Bad mojo. Okay. Here's our thoughts for the day. One time my wife had a suspicion that I might be cheating on her, so I said, "Honey, you got nothing to worry about. I'm not interested in disappointing another woman." And, do you realize that if Venetian blinds hadn't been invented, it would have been curtains for all of us? Oh, that's really bad. That's so bad, I have to laugh. Even Kramer's laughing at that one. All right, audience, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. Welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Rob Spinoza of RPM Mortgage. Our phone number is 888-912-1190. Write that number down, 888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. And today's trivia theme is presidential quotes. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. And Mr. Kramer is recording us on for television, Comcast Channel 26 and AT&T Channel 99 on Saturdays at noon and Sundays at 6 p.m.
But I have a face for radio.
You have a face for radio. There you go. Okay, now we have today on the phone we have a special guest, Gene Miller from Desert Gold Exchange. Gene, welcome to The Best of Investing.
Oh, thank you so much for having me.
Okay. Hey, Gene, Mark Hanf here. So your visit with us today is very timely because, you being an expert in precious metals, how is the current government shutdown and the upcoming debt limit affecting gold and silver markets right now?
Well, there's really 2 effects. There's always a knee-jerk reaction that we see. We typically try to ignore those because, gold can, one day it'll be up $20. Next day it'll be down $20. Right now, today it's currently down $20, and silver's down 25 cents. I'm more concerned about the long-term implications as to what's going on. We got this government shutdown due to the fact that the Republicans don't want Obamacare. Well, I understand that. I mean, Obamacare, for those that don't have insurance, I get it. But this is going to have an overall effect on our economy. I'm just an average person with excellent health, and yet my premiums are going to go from $300 a month to $600 a month. And I've got a lot of clients that have told me the same thing. You couple that with the fact that you got 75% of the society, according to CNN, that are living paycheck to paycheck. Now you're going to increase the amount of things that they're going to have to spend money for. So this is going to add a big weight on the overall economy. Then you got the debt ceiling. We are going to raise our debt, whether we like it or not. We're going to continue raising our debt. So we're going to go from 17 trillion to 18 trillion to 19. Eventually, we're going to get farther and farther down the road. We keep kicking this can. And so the overall thing is we look down the road, what's this going to affect the gold market? I think it's going to affect it very positively. And so we try to, get people to not look at the immediate thing, but look at down the road, how am I going to protect myself when things really get bad, the dollar really becomes weak because of what they're doing today. It isn't always an immediate thing that happens. It's what happens down the road that we're concerned about.
So based on that, what's happening, Gene, you see, you're I guess you would say, you're bullish on the long-term outlook for gold?
Yeah, on the long term, yeah, absolutely. But, the last couple of years has been very bearish, but, I haven't sold anything because I'm looking at what we're doing today, how is it going to affect me 5 years from now, 10 years from now? What's the dollar going to be like? I think that sooner or later we're going to lose our status as the world reserve currency. When we do, we're not prepared for that in this country. If you've ever had a chance to travel outside of this country, gasoline, different things like that have always been twice the price, and it's because everything's denominated in dollars. Well, if we lose that and it goes to the Chinese currency or some other basket of currencies, we're going to all of a sudden wake up and instead of paying $4 a gallon for gas, we're going to be paying $8 a gallon.
I don't even know how to spell the word yuan.
So, Gene, I've invested in precious metals funds, but what should people look out for when they're actually investing in the metal itself?
Spreads. And what I mean by spread, what's the difference between the wholesale and retail price of the coins? There's some companies out there that they're just really, really large spreads. And they don't.
I see.
If they just listen to some endorser and they buy because some endorser told them to buy from company XYZ, they might get their head handed to them. So always ask the question: if I buy a coin today and I sell it to market tomorrow, and the market didn't move, how much am I going to get back?
That's a very good, honest question to ask.
Very specifically worded. I like that.
I like that very much.
And so that's the number one thing. People just don't realize to ask that. They think, well, I'll just buy this, and it sounds like a good deal because so and so said to do it. You got to be very careful. Ask that. So what is the spread? What am I going to get back?
That in effect is a sort of appraisal, but not really. I mean, it's just a point blank question on it. Yeah, exactly.
Say that again now?
So it's similar to an appraisal almost. What's the appraised value of that coin then? In other words, going back on the market.
There's some things that, if you realize that there's companies out there that will sell stuff with a 40% markup.
Right.
And you go to sell it back, you're going to get, you spend $1,000 and you get $600 back. That's a pretty big hiccup.
That's not so good. Well, let me ask you then, this is Edward, how much metals do you recommend in a person's portfolio?
Well, we do that on base, but we don't do it on a cookie cutter type of deal. If all things were equal, if we look at what happened in like 2008 when the markets began to crumble, the banking market crumbled, and the housing market and the stock market took a big hickey there. What would it have taken in gold? Because gold was definitely going up during those times when those things were going down. The break-even point at that was 20%. Now, not everybody can put 20% of their assets into gold because some of these people that we're dealing with living off of their money. So you got to kind of look at it on a case-by-case basis. But at the most, probably 20%. Somewhere between 10 and 20%.
Hey, Gene, Mark here again. If I want to buy gold and I want to have some gold, let's say in my IRA, am I able to do that with one of my traditional IRAs that I may have with my bank or like a Merrill Lynch or Schwab, or do I need to have it in a self-directed account?
Well, with the company that you currently have, most of them, like Merrill Lynch or something, Charles Schwab. Charles Schwab used to do it, but they got out of it. So you're going to have to convert that over into a self-directed IRA that is designed to own gold with a custodian that allows you to own physical gold. And there are several of them out there that we deal with.
One of our favorites is IRA Services Trust Company in San Carlos. Their fees are about the lowest.
Yeah, I was just going to ask, because what's the fee structure on something like that? Because I imagine on every angle of it, there's a fee associated with it.
Yeah, I think there's about the lowest.
There's a custodial fee, and it depends on how you set these things up. If you set it up where the gold is stored for you in an outside depository, that can be as much as $160 a year, which covers the custodial and the storage. These also can be set up through an LLC where you get to store the gold yourself locally there. The fees generally end up running around $225 a year.
Okay, so
so it sounds like it's similar for those people who want to buy real estate in their IRA, or maybe do participate in private lending or mortgage investing. You need to have a self-directed IRA where you've got a lot more flexibility in what you invest in. And sounds like for the gold products you recommend, you would recommend that they do so in a self-directed IRA.
Correct. Yeah, okay. And most of my clients, we don't make any commission or anything on how they set this up as far as an IRA. We make our commission on selling them the gold. So we just do that as a service to them. But most of our clients go the route, kind of like what you're talking about with real estate, where they set up the self-directed IRA, they create an LLC to run this all through there, and that's how they buy their gold, is through that LLC that's part of their IRA.
Well, Gene, getting to the specifics, I've heard about, obviously, the Gold Eagles and Maple Leafs and the Krugerrands. What do you feel is the best way, best form of gold to own?
Well, you're right. Not all gold is created equal. There are what most people are familiar with, bullion, which is like the Gold Eagles, the Maples, and the Krugerrands. Then there's another category of gold which is called numismatic gold, and it's like your old $20 gold pieces. Personally, I like the $20 gold pieces because in the market that we're in right now, they always outperform bullion. So, for example, if gold goes up $1, a bullion coin is going to go up $1, whereas a numismatic coin will typically go up about $1.50. So it's got a better upside potential. It doesn't always fall in the market like bullion does because nobody's dumping large amounts of numismatic coins onto the market, so it's a little more stable on that. The other thing is that it's completely private. If you buy it, you sell it, nobody's ever going to ask you for your Social Security number. And if the government ever did, like they did in the past, say, hey, we need you to turn in your gold, it's there. It's happened before. I don't know if it'll happen again, but if it did, numismatic gold is exempt. So it just has some definite perks that I like. Now, when we talk to our clients, we just kind of show them the whole gamut, give them the pros and cons of everything, and let them decide for themselves. Our thing is here, we just try to educate people as to what's available, how to do it, what's the mechanics of it.
Well, hey, Gene, do you
push them in one direction or another? We show them what's available and let them decide for them.
Well, Gene, I was going to ask you, do you grade the coins yourself? Because I know there's differences.
Any of those type of coins are all graded third-party independent grading companies like PCGS or NGC, who guarantees those coins, so that the client's never going to be at risk if they buy something from us. If they take it someplace else, they're going to get a big surprise. Well, it's not really what you.
So, Gene, this is Rob. So that was my next question for you: is why Desert Gold Exchange? I mean, anybody that's out there can hear tons of ads about all this stuff, but why you guys instead of someone else or your competition?
Well, I think number one, we take great lengths to have a lot of integrity. We're a family-owned company. We're very, very big on making sure our clients are happy, that they are taken well care of. We don't surprise them with anything. We don't play this game, like when we talk about things to avoid. There's companies out there that might sell things for a little bit cheaper, but if you read the fine print, they're going to keep your money for 4 to 6 weeks, and they're going to play the market on you. We do not do that. You're going to have your coins within 72 hours. So it's
that's good.
Better service, better prices, better integrity, and really that's what it boils down to.
Very good. Gene Miller from Desert Gold Exchange, thank you very much for educating us about gold.
Well, I appreciate it. Thank you
so much
for having us on.
All right, we are going to cut to our first commercial break here, and again, the theme is presidential quotes. And here's the first one. Which president said, "Ask not what your country can do for you, but what you can do for your country"? Not a very good accent by me, but that's okay. Don't touch that dial, because when the best of investing comes right back, we've got some interesting emails to answer. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money and Rob Spinoza of RPM Mortgage. When we cut to the first commercial break, we asked this presidential quote trivia question. Which president said, "Ask not what your country can do for you, but what you can do for your country"?
John F. Kennedy.
John F. Kennedy.
John F. Kennedy.
That is correct.
Anybody who doesn't know that needs to go back and take their citizenship test.
That's right. Yeah, good point. Okay, Rob, we received an email for you that says, "I've never heard of RPM Mortgage before this program. How safe is it to refinance with them?"
Oh, okay. Incredibly safe to refinance with us. RPM is a very large non-depository mortgage lender here, headquartered here in California, in the Bay Area, Alamo to be precise. Been in business since the early 80s. Family started operation, and our motto, "Can do, will do," is pretty much lived up and down the chain. It's really a great company to work for. We have a lot of very stable, very strong correspondent relationships. We also have a direct line and a direct endorsement with Fannie Mae, and direct endorsement with the FHA. And so there have been no stability issues with our company throughout all of the years, boom and bust years. And we continue to originate many billion dollars worth of mortgages every year. It is safe to refinance with us. I will also add, it's still a very good time to refinance. Rates are higher than they were back in the spring, but realize we're going into a period of time at the beginning of 2014 that will be regulated with greater scrutiny by the Dodd-Frank bill and the Consumer Financial Protection Bureau. So if you have an opportunity now, you've got very good rates still. You have a lot of the credit qualifying criteria that we've become accustomed to, and you also have home appreciation. So you rarely see all of those things line up at the same time. If you have a good refi opportunity, still a good time to look at it.
So Rob, RPM, it's you guys are your own mortgage bank. So how do you differ from, say, if I wanted to go to B of A, Wells, Citi, or Chase for a home loan?
The primary way we differ is that because we have various correspondent channels, we have various investors. So for any given product, we have a selection of investors that are pricing that loan. So whereas when you go to a single entity, a Wells Fargo or a Bank of America, they're offering their product at their price. If it's competitive that day, you're in luck. If it's not, they don't have an option to go to another investor within their own control and deliver that loan, and we do. So for example, we may have 5 or 6 investors. We don't relinquish control of that loan, so I remain your point of contact, and I'm the accountable person throughout the start to finish. But we also have the variety in pricing, which could afford you a better interest rate.
Your paperwork is the same as the bank, isn't it?
Yeah, I mean, I think there's a general misconception about paperwork that if you walk down to your local branch, they're going to give you some sweetheart deal and you won't have to prove anything. And I think that most loans originated these days.
Not true.
Exactly. So most loans originated these days are fully documented loans. That generally implies tax returns, W-2s, pay stubs, bank statements, etc.
Proof of income.
Proof of income. So
the funny thing is if I'm the borrower, once I have the money from you,
right,
I don't care that much about you.
Right,
I'm
exactly.
the guy who has to make sure I can make the payments to you. I just want to make sure that you're going to give me a good deal.
Well, that's actually a very interesting component of the Dodd-Frank bill, is what's known as the ability to repay component of it. And that is where the lender is now going to be making a judgment call on your future ability to repay that loan. So it's going to get quite interesting as to how they're going to draw those lines.
If I smile nice and show my pearly whites.
I thought the guy was going to pay the loan.
Sounds good to me.
Doesn't quite work that way anymore, and won't. But,
okay.
So bank where you want to bank and borrow from who gives you the best program.
Yeah. We really do have a sweet spot in California lending, and I believe we offer a great service to our clients. Combination of factors that make us right there in the middle of what.
Now, aren't you guys one of, if not the largest non-bank lender in the Bay Area?
Yeah, we are. We do a ton of business throughout California and the Bay Area.
Very good.
Yeah.
And you'll deal with people all over the Bay Area?
Absolutely, all over California.
Okay. So for new listeners, I'm Mark Hanf, president of Pacific Private Money. We are one of the premier private money lenders to real estate investors in Northern California. And so we specialize in making loans that the banks don't make, and the banks right now for the last 5 years have not been making many loans to real estate investors. So if you're a real estate investor, you know someone who likes to buy, fix, and flip property, or maybe buy property for rental income for long-term hold, or maybe owns existing property that has equity and they want to borrow against it. More often than not, if you go to any of the banks, they'll say no for lots of different reasons, primarily just because they're making lots of money right now doing consumer home loans. They don't need to serve that market right now, and they have not been since 2008 when the subprime meltdown occurred. So the listener's question was, we hear that you make loans based on the as-is value, not the ARV. And what ARV stands for is after repaired value, or also known as the future value. And what that means is that a lot of our borrowers come to us and they say, wow, I've got this great deal on this property. Maybe it's a short sale or a bank-owned property, and I'm going to fix it up and I'm going to sell it for a profit. So maybe they're buying it for $200,000. They're going to put $25,000 or $50,000 into it, and based on their homework, they believe they're going to be able to sell it for $400,000.
Right.
And again, those metrics are not unusual. That's we do a lot of lending in the East Bay, and I have a lot of clients who come to me and they're buying a home for $200,000 or $250,000, putting in a repair budget and turning around and selling it for $400,000 or $450,000. And so oftentimes a borrower will come to me and say, hey, can you make me a 70% loan, but based on the future value, not the price that I'm paying for it? So in other words, they'd be saying, can you make me a loan based on the $450,000 future value? Which oftentimes, if I'm making a loan, if I were to make a loan at 70% of the future value, I'd be making them basically 100% financing on the cost.
Exactly. No.
So the answer to that is no, we don't.
All right, guys, any last words before we get into our thoughts for the day?
Yes, I wanted to announce
that's right.
the Pacific Private Money Fund is having a fund launch party in Mill Valley on November 6th. That's Wednesday, November 6th.
Oh, okay.
Wednesday, November 6th at 6 p.m. at the Piatti Restaurant in Mill Valley.
Good for you guys.
We've got, we should have close to 100 people there to meet the Pacific Private Money staff, and you can meet the Best of Investing co-host there as well. And we're going to talk about mortgage investing and introduce people to our new mortgage pool fund.
How do people RSVP?
Call our office at 415-883-2150.
It's a free party for appetizers.
Nice little place, too.
Go to PacificPrivateMoney.com for more information.
All right. Thoughts for the day. Holding a grudge is letting someone live rent-free in your head.
Yeah.
Isn't that true? And I always give 100% at work. 13% on Monday, 22% on Tuesday, 26% on Wednesday, 35% on Thursday, and only 4% on Friday. Yeah, that totals 100%. Okay, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.